Hello everyone. In this video, I'll be discussing the accounting for tangible and intangible assets. Let's begin with tangible assets, particularly for property, plant, and equipment, or PPE for short. For manufacturing firms, the largest asset usually is property, plant, and equipment. And in this video, we'll discuss the concepts of depreciation and amortization that relate to PPE. We'll also talk about the accounting for gains and losses that arise when a firm sells some of its PPE. And lastly, we'll also discuss the accounting for impairments of property, plant, and equipment. To illustrate the accounting for PPE, we'll consider 2 years of transactions. Let's say at the beginning of year one, the firm purchased $1 million worth of buildings to conduct its business. Building A for $700,000 and Building B for $300,000. How will the accounting work? Well, PPE has come into the firm, so we will increase PPE as an asset on the balance sheet. At the same time, if the firm has paid cash, cash goes out of the firm, so cash will go down by $1 million. That'll make the balance sheet equation balance. Notice that there is no effect on liabilities and equity, and there has been no wealth has been created or destroyed, so there is no income effect as a result of this transaction. In case the firm has been purchasing these buildings on credit, the accounting will be slightly different. The PPE will go up by $1 million. That'll be no difference in that particular aspect of the transaction. However, instead of cash going out of the firm, we will have a liability in the books and there is no income statement effect. And this liability is called notes payable, unlike accounts payable for inventories, because the firm usually enters into a long-term arrangement in the form of a note. Now let's talk about the concept of depreciation expense. Depreciation expense is nothing but allocating the cost of the building, that is the purchase price, over the time of use for business. There are very many different ways of allocating the cost and hence many different depreciation methods, from simple straight line to more complicated methods. We will not get into the details of how the depreciation is computed. So for the sake of argument, we say, let's assume that for the first year, the firm determines the depreciation to be $100,000, that is straight line over 10 years. Now, what will be the effect on the balance sheet equation? Now, notice that this is a cost of allocation, and hence there will be a reduction in the equity side of the balance sheet because it's an expense, and we call it the depreciation expense that will feed into income and through that to retained earnings. So there is a reduction in net income as a result of this expense. Notice that there is also a decline in the value of the asset, so PP&E should decline as well by $100,000. But then we have many different assets. In our case, we have Building A and Building B, and we want to differentiate the original cost from the depreciation, so we do not reduce $100,000 from PPE directly. Instead, you guessed it, we'll be creating a separate contra asset account like accounts receivable so that we can capture the depreciation that gets accumulated for each asset separately. So we have two accounts. We have the PP&E, we have the contra asset, and we call the contra asset accumulated depreciation. Basically, we will park all the depreciation associated with each of the assets in this particular account. So the $100,000 that we have actually recorded as depreciation will increase accumulated depreciation. Because it's a contra asset, it'll reduce the asset side of the balance sheet, making the balance sheet equation balance. Now, the balances in the PPE accounts can be summarized as follows. On the PPE account, which captures the original cost, the beginning balance is $0. We've added two buildings worth $1 million. So the ending balance is $1 million, representing $700,000 for Building A and $300,000 for Building B. For the contra asset accumulated depreciation, the beginning balance is $0, and we have added depreciation expense of $100,000, so the ending balance is $100,000. For Building A, it is $70,000. For Building B, it is $30,000. So on net, the balance of PPE on the balance sheet should be $900,000, which is $1 million minus $100,000 accumulated depreciation. Just to separate out the PPE and accumulated depreciation accounts, sometimes the PPE is called PPE gross account. Now, one last thing. At the end of each period, the accountant will determine whether any of the assets have been impaired. That is, if the value of the asset is actually less than what is being reported on the balance sheet. Now, how does one determine the impairment? Now, while the actual determination is slightly more complex, we will simplify it for our purposes. Let's say that the accountant will determine if the fair value is lower than what is in the books. That is, if the book value, that's the amount on the balance sheet, is greater than the fair value, then the account will write down the value of the asset in the books down to the fair value. In other words, the accountant will record a loss on the asset. At the end of year one, let's say the accountant has determined that the fair value of building A was 800,000 and the fair value of building B was 450,000, which is much greater than what is in the books. So as a result, there is no impairment that is necessary for this year one. The balance sheet will be represented as follows. With respect to PPE, on the asset side of the balance sheet, we'll have a property, plant, and equipment of 900,000, net of accumulated depreciation of 100,000. That is, the purchase price was 1 million, accumulated depreciation was 100,000, so what's on the balance sheet is the net amount of 900,000. In the income statement, the amounts that are related to PP&E is the depreciation expense. Apart from the revenues and the cost of goods sold, there will be a depreciation expense which reduces net income by $100,000. This concludes the transactions for year one. Let's pause here. If you're comfortable with the material thus far, continue. If not, just review them before proceeding. Now let's talk about transactions in year two. Let's say at the beginning of second year, the firm decides to sell building A for $800,000 cash. Now, before we get any further, let's look at the opening balances for PPE and accumulated depreciation. Note that the ending balance of year one is the beginning balance for year two. So for PPE, we know that the beginning balance is $1 million, which is representing the buildings A and B worth $700,000 and $300,000, which is the purchase price of the buildings. On the contra asset accumulated depreciation, there's a beginning balance of $100,000, representing amounts for building A of $70,000 and for building B $30,000. Now let's focus only on building A because that's what has been sold. The balance of PPE for building A is $630,000. That is 700 minus 70,000. Let's keep that in mind as we move forward. So the firm essentially sold $630,000 worth of buildings, that is building A, for $800,000. So in other words, the firm has actually made a profit of how much? $170,000, which is the difference between $800,000 and $630,000. So how do we record this event? We have to do it in steps. The first step that we'll take is we'll first remove building A from the books because it no longer belongs to the firm. And how do we do that? We have two accounts with respect to the buildings, which is PPE and accumulated depreciation. So we need to remove those accounts separately. So we know that the PPE, the original purchase price of building A was $700,000. So we need to remove $700,000 from PPE account. This way we remove the purchase price of building A from the books. Then what we will do is we'll remove $70,000 from accumulated depreciation because that is what is left for building A in that particular account. And this will remove the accumulated depreciation of building A from the books. Combined, what we have done is we have essentially removed $630,000 worth of asset from the books that belong to building A. All right, so what remains in the asset account is basically the PP&E of building B. Now let's record the cash that was received from the sale. Notice that the firm sold it for $800,000. So let's assume they received cash. So in which case, cash will go up by $800,000. Now notice with these two steps, the balance sheet is still not balancing. But I know you're thinking we made a profit, so we need to record that. That's what we will do next. So the step 3 would be recording the gain from the sale. Now, given that it is a gain, wealth has been created to the firm, and so equity will go up, which is retained earnings will go up. But the income statement, the gains will be noted separately, and that's why you can see that I've added the gains and losses as a separate item on the income statement, which will increase net income, which will again feed into retained earnings. Now the balance sheet balances. Now let's move on to year 2, and the firm continues to do business with the use of building B. So now we have to record the depreciation for year 2 for building B. And remember that we had depreciated over 10 years, a straight line for building B, which is $30,000 each year. Now let you pause and answer this accounting for the depreciation for year 2. Did you get it right? Let's check it out. So we know that $30,000 is an expense, and that will add to the accumulated depreciation for building B in the asset side of the equation, which will reduce the assets on the balance sheet. And it is also an expense, which is $30,000, which will be affecting income statement, which will feed into retained earnings. Notice that we'll continue to depreciate this asset as long the asset is not sold or until it reaches 10 years of use, which is what the firm is planning to use. Now the balances in the PP&E accounts can be summarized as follows. On the PPE account, we had a beginning balance of $1 million. then because of the sale of PPE, sale of building A, we need to remove 700,000. So resulting in what is left is just building B. On the accumulated depreciation, the same thing is true. We remove the accumulated depreciation of building A, but in addition, we have also added 30,000 of depreciation for building B. So the ending balance of accumulated depreciation is $60,000 pertaining only to building B. So the net amount on the balance sheet is $240,000, representing the value of building B. $300,000 on the purchase price minus $60,000 of accumulated depreciation for 2 years of depreciation at $30,000 each. Now let's not forget, the accountant will have to perform the impairment test. Now let's assume that the accountant determines that the fair value of building B is only $200,000, which means it is lower than the amount that is on the balance sheet, which is $240,000. So clearly an impairment should be recorded. And there are two ways to record the impairment. I'm going to suggest the easier way to treat the impairment expense as an additional depreciation. So you treat it just like the depreciation expense. So how do we record it? You can do it yourself and test it out. So I'm going to do this for you. So the accumulated depreciation goes up by 40,000 because we have added more depreciation to building B. And in addition, we have lost wealth. And as a result, we have an expense in the income statement. And that will feed into retained earnings as a negative number. So net income goes down. But instead of calling it depreciation expense, we call it an impairment expense so that investors will know exactly what this item is. So now let's update the PPE accounts for the impairment. So on the PPE account, there will be no change because we still have building B. On the accumulated depreciation, we will actually include the impairment charge as an increase to the accumulated depreciation, resulting in an ending balance of 100,000. Now, what do we see on the balance sheet? Well, the net amount of PPE is 200,000, which is a difference between 300,000 and 100,000, which is actually the fair value of the asset. And that's what we want to depict in the financial statements. So now let's see how the balance sheet looks with respect to PPE. On the asset side of the balance sheet, the property, plant, and equipment, which is building B in this case, will be $200,000, which is net of accumulated depreciation of 100,000. Now notice that the $200,000 is actually the fair value because it has been written down to the fair value because of the impairment. On the income statement, the firm will present the following information. Apart from the revenues and cost of goods sold, we'll have depreciation expense and the impairment charge of $30,000 and $40,000 that will reduce net income. And don't forget, there's a gain on sale of PPE, which will increase net income by $170,000. That concludes the transactions for this company for year 2. Now let's talk a little bit about the intangible assets. What are intangible assets? When a firm buys some intangible assets, these are resources that do not have a physical presence, such as trademarks, copyrights, and brands, etc. The accounting for purchased intangible assets is very similar to what we did for tangible assets. However, instead of depreciation and accumulated depreciation, we use the terms amortization and accumulated amortization. And usually firms report depreciation and amortization together in the income statement. And like tangible assets, intangible assets are also subject to impairment tests. Now, there are some internally developed intangible assets such as R&D, but that is beyond the scope of this video. This concludes our video on tangible and intangible assets.